Valutrades.
Good afternoon, good morning, good evening, where you happen to be. Welcome to the Valutrades webinar on one of our favorite topics, the global economic crisis and how to trade into it. Our title of this webinar is Trading into a Recession, but let's get into that because we're not sure, or a lot of experts aren't sure, whether we are actually in recessions. It depends where you are in the world and how you define recession, but that's one of the things we're going to be covering in this webinar. My name is Brad Alexander, and if you follow me, if you follow Valutrades Mondays and Tuesdays, you'll know me from the Market Blast webinars. And of course, over the years, I've done a variety of courses and trader education videos for Valutrades. So hopefully you know me and you know my voice by now. One of the things that I would highly encourage you to do if you want to be trading into our lovely economic crises that are happening all over the world is follow the Market Blast fundamental and technical videos every Mondays and Tuesdays, because I'll be updating you on what's going on in the world, the best pairs to trade, and basically what's going on to help you trade successfully every day. As you know, I've been with Valutrades for many years. I'm a professional and retail trader, and I've been providing content and following the markets for many years. So hopefully my knowledge and my videos and my webinars are passing on some knowledge and experience to you, and I hope you're having fun trading with Valutrades. But don't forget, CFDs and FX are leverage products, and I highly encourage you to read the disclaimers on the Valutrades website to ensure you understand what you are doing. If you're not familiar with Valutrade, or if you're not familiar with trading, please trade on a demo account, and you may pop onto the chat on the Valutrades website to ask advice on how to run the platform. Which way to go on the Valutrades chat line. And of course, please follow my videos. Hopefully you learn something and learn to make some money trading with Valutrades. So let's take a look at what we're going to be talking about today. I want to give you a quick history of economic crises basically throughout time. I don't want to make this webinar into a history lesson, but it's important that we take a look at what's happened in the past to understand the way investors think, the way the markets think, and a lot of these ancient crises that have happened over many, many centuries are repeating themselves over and over again. We keep thinking, oh, it's never going to happen again. This will never happen again. Well, things are around the corner that just sneak up on us, sneak up on the banks, sneak up on the central banks. So I want to go through a quick history lesson on a variety of economic crises. We could spend hours talking about that, but I won't. I promise I'll go through it as quickly as possible. And I want to talk, of course, about the current economic crises that we are in now, and how we can trade it. I want to look at the definition of a recession. This is a tricky topic. A few years ago, or even a few decades ago, a recession was quite clearly defined, but so many things have happened in the last 10, 15, 20 years, or even 2 years that have completely turned our economics and our understanding of the markets upside down. So many people say we're in recession. Many people say we're not in recession. Many people are predicting recessions, but it all depends on how you define it, what you're looking at, where you live in the world, whether it's in Europe or the States or Asia. So that's another thing that we need to look at. So I wouldn't put too much emphasis on the word recession, and I'm going to go into some of the different ways that we define recessions and the things that we're dealing with right now and the things that the central banks are dealing with right now. Right, and we have different crises happening around the world. It may seem to you that we are in one gigantic mess, which we are. The whole planet's in very interesting situations going around the world. But if you look at the individual economies, there are a lot of differences that are going on. And it's important to understand the differences between, say, Europe and the United States, or Japan and Great Britain. They're actually vastly different. And if you drill down and look at the microeconomics of it, and it also makes a difference on how we trade these different economies and different currencies and different indices. So you're asking the question, which economies do better in a recession? Well, the bottom line, and I'm going to skip ahead to a slide which I'll show you in a little while, inflation. Right now, the biggest problem that the world has is inflation, and different economies have different levels of inflation, and some for different reasons. And we're going to be getting into that and how we can take advantage of that. So the central banks and governments are doing their darndest to fight inflation, and that's one of the things that we're following. All investors are following this because it affects everything that we do. Sometimes the governments will do things that really have no effect on the economy, but they're doing it for political reasons. Like just the other day, Joe Biden topped up the strategic petroleum reserves, which basically had no effect on anything, but it was a nice thing to do ahead of the midterm elections. But the central banks are looking at raising interest rates and cutting bond purchasing, which has a huge effect on the economies. And as traders, we really need to know, we really need to be aware of what's going on and who's going to be doing what and what the rumors are on the street. So we'll be going through all that as well. And of course, what we should trade and in what order. Again, when the central banks raise interest rates, they do it one after the other. They don't all do it on the same day. So because we trade in pairs very often, it's important to understand who's going first, who's going to be, as we say, playing chicken, who's going to jump out of the way first. So we're going to go through all that and hopefully give you some idea as to which way you'd like to trade the markets and what to look out for. Again, I'm going to go back to my Market Blast videos. And every Monday morning, I look at fundamental analysis, and every Tuesday morning, I look at technical analysis. Well, everything we're going to be talking about here today is strictly fundamental analysis, and that is the most important. You may have seen my order of analysis. Fundamental analysis is always on top. So it's important that this may be a very dry subject for a lot of people, and you may think you may not need to get involved in what's going on in the world, but it is very important to keep up with what's going on. Right, so let's have a quick history lesson. 1637, that was a very long time ago, but we had a thing called Tulip Mania. You may have heard of it if you've been trading for any length of time. And Tulip Mania was basically the first bubble that happened in Holland. People were buying tulip bulbs. Yes, I'm not making this up. If you don't believe me, Google it. And it was the first bubble. People were the frenzy was carrying on for many months, and people were paying the equivalent of 6 years' salary of an average salary, and sometimes a tulip bulb would go for the price of a large home. It was absolutely crazy, and they thought the same thing then that they've thought through every single economic crisis since then, is that the price of tulip bulbs was going to go up. It would never, ever come down. Well, of course, it crashed. That market crashed. It didn't dramatically affect the Dutch economy, but it did wipe out a lot of investors because a lot of people were actually buying tulip bulbs on margin. They were actually taking out loans and even working with derivatives on tulip bulbs, even back in the 1637. So this doesn't affect the way we trade today, but I just wanted to show you that bubbles and mania and silliness can happen in the markets, even back in the 15th century. There are a myriad different crises that have gone on throughout the centuries, and I won't go through every single one of them. But another one was what we called the South Sea Bubble, and that was when the UK first got involved in the stock market. Up till then, the East India Company was the largest company in the world. There were 3 East India companies, and they were basically shipping. There were ships going back and forth between Europe and Asia. And there was a huge trade in everything, of course, getting goods back and forth. And what happened then was it was great for investors because they could actually invest in individual voyages as opposed to putting all their money onto one voyage, which may have been attacked or may have sunk, may have been an accident at sea. But if you could spread your risk, your investments over several voyages, and 9 out of 10 made it home, you could still be a rich person. So that was working out very well for investors in the 1700s. Then the South Sea Company came around, and they got the contract to ship into South America, and a lot of that was to do with slaves, sending slaves from Africa to South America. They had a quota of 4,500 slaves per year, so it was a rather horrific story. I won't go into the details of it, but that company failed for many reasons. One was that they couldn't crack the Spanish monopoly on shipping into South America, firstly because of the language, and also even the idea of trading slaves wasn't working out with everybody at all. But unfortunately, a lot of people invested in the South Sea Company, and the South Sea Company was very badly managed, spent a lot of money on very expensive offices in the United Kingdom, and the government, as they do now, had to bail them out. So that created an economic problem, even back in the 1720s. So these economic crises carry on, and we never seem to learn our lesson. Then, of course, there was the famous one, the Wall Street crash of 1929, and it was the same story again. Everybody thought the stock market would go up. Everybody was investing. Everybody was leveraged. Everybody was trading derivatives. And unfortunately, in those days, the game was rigged. The big brokers and the exchanges were actually encouraging people to invest when they knew that the whole thing was going to collapse. And when they finally started selling to cash in, there was no safety net. There were no government bailouts. It was a complete and utter disaster. The Wall Street crashed. It rippled around the world. So, for example, if Wall Street crashed in October of 1929, by 1931, depression had hit Europe. And then, of course, we had the rise of fascism in Germany. This was a huge problem, obviously. Nowadays, hopefully we won't have any more crashes. We have had some crashes, obviously. But I'm going to go through those in a minute. But that was probably the biggest one of all, the Great Depression, that started by huge frenzy, a huge bubble. Everybody was buying stocks, and they never ever thought these values were going to come down, and they did. And we had the dot-com bubble in 2000. That wasn't such a huge thing for the economies. It did definitely affect a lot of companies. And a lot of companies survived out of it, like Amazon and even Facebook came out of it. But it was a frenzy of investment. People were investing money there in companies that really had no value, just an idea, just a concept. And some of these companies that were basically doing nothing had larger market capitalization than, say, General Motors. It was just craziness. And I think I was one of those people who saw it. A lot of people saw it and just simply did not invest. It just didn't make any sense. And the dot-com bubble burst in 2000. And a lot of companies just went to the wall. A lot of people left big banks to work for these companies, and of course they had to come back, tail between legs and cup in hand to get their jobs back. It didn't cause a massive financial crisis, but it did show the world that the idea of mania and the idea that these valuations will never ever come down was still in people's minds and still in investors' minds. So the Tulip Mania was carrying into the dot-com bubble mania from 1999 into 2000. Then we had the famous subprime mortgage crash of 2008, and it was the same kind of thing. It was a bubble, but it was based on real estate in the United States. This didn't happen all over the world. It was strictly an American problem. But one thing you need to keep in mind as traders is that the U.S. economy is the largest economy in the world. And when they get a cold, the rest of the world very often catches it. And if you don't know what the subprime mortgage crash was, simply watch two films. One is The Big Short. It graphically displays exactly what happened through the eyes of four investors. And you can also watch Margin Call. So basically what happened was there was a mania of home buying because nobody ever thought that the price of homes would ever come down. They were going up and up and up. So these mortgage brokers were basically signing up anybody and anybody who wanted to buy a home. And some people many cases had many homes because they were leveraged to the teeth. They didn't understand teaser rates that were going to change into full high percentage mortgages in 2007. Some people had very, very little income, but they didn't have to prove it because basically a mortgage broker could sign somebody up with almost no income and no proof of income, and then days later sell that mortgage to a big bank a few days later, and they'd be free and clear. They had no responsibility, no verification, no idea what they were doing. Well, they had an idea what they were doing, but unfortunately the poor victims, the people who bought homes and got these mortgages, didn't know. So basically you had a multitude of insurance policies and bonds all wrapped around these worthless mortgages, and the entire economy crashed in 2008. And of course that rippled around the world, and everybody else caught the cold from the subprime mortgage. One of the things that happened, though, was that the American government bailed out a lot of the big companies like Fannie Mae and Freddie Mac and AIG Insurance. but they didn't bail out Lehman Brothers. And the reason was, and again, watch the film Margin Call, you'll find out why. The government was between a rock and a hard place because Lehman Brothers had all of their bad debts and basically sold them off in a frenzy to other banks, and a lot of it went to Barclays in the United Kingdom. So the American government really couldn't bail out Lehman Brothers because of their shenanigans. They were between a rock and a hard place. So I personally, I'll tell you my own personal situation. I was running a project management company in southern Spain, and the day that Lehman Brothers went out of business in 2008, my phone stopped ringing. Basically, the whole global economy came to a grinding halt in 2008. And I'm going to show you what happened there in a second. So basically, here is what happened. The little yellow box in the top of this chart, on the euro-dollar chart, is when Lehman Brothers went out of business. So basically, as you know, as traders, being the quote currency, the euro-dollar went down. That means the American dollar got very strong. And this is an important distinction to understand when you're trading. When things go wrong in the United States, it doesn't really mean that the American dollar is going to get weaker. It's going to get stronger. And this is a prime case of what happened with the big crash. The American dollar got stronger. Why is that? Why? It just doesn't make any sense. And if you want to impress your friends, show them this chart or any other chart on the American dollar after the big crash of 2008. Well, here's why. This is a chart of the Dow Jones Industrial Average during the same period. So what happened was everybody bailed out of the stock market, and the Dow Jones Industrial Average, as you know, is made up of the 30 largest companies in the United States, including the banks. So of course the banks failed first. Bear Stearns went out of business very quickly. Morgan Stanley lost like $15 billion in with the subprime crisis, and I could go on. So these companies that were in the Dow Jones, that are in the Dow Jones Industrial Average, lost a lot of money. Investors, of course, ran deserting a sinking ship, and they basically sold their shares. So when you sell your shares, what do you get back? You get cash. So think of it this way: you're trading these shares, you're getting rid of these shares that you don't want because you're scared, and the prices are going down. You get back cash. So suddenly that cash becomes more valuable. That's why the American dollar gets stronger when there's a crisis like this. And it's one of the few economies where that happens, but it's important to understand the distinction. So, okay, so the Dow Jones Industrial Average crashed because it was full of banks. Well, basically, if you look at the NASDAQ, which has basically no financial service companies in it, people call the NASDAQ the Tech 100. It's more than tech. It's tech companies, it's pharmaceutical companies, it's even got some entertainment, leisure in there as well, but it doesn't have financial services. It crashed as well because it followed along with the banks. When you've got leverage with a bank, or you've got a loan with a bank, doesn't matter what size your company is, and your bank goes out of business or suffers, your company suffers as well. Consumer confidence suffers, everything suffers. So it doesn't matter if you were a bank or not. All the stock indices all over the world basically tanked after the 2008 crisis. So for traders like us, this is an opportunity. So I'm going to mention the first opportunity now. One of the things that's key, and I know that the title of this webinar is Global Economic Crisis, Trading into a Recession. Trading in a recession or trading in a crisis is really not much different than trading day by day. The difference is you have more opportunities. The bad news is you have more volatility. The good news is you have more volatility. You need to be very, very careful when trading these. But when I see a big crash like this, doesn't matter whether it's oil or a stock market or a currency pair, to me, that's an opportunity. Not to jump in when it's falling like a knife or going up like a rocket. Wait until my strategy is to wait until the dust settles and catch it on the way back. That's worked for me all my life. I've never been one of those traders who jumps in when I hear the news and hopes to catch the wave going down, I have made trades like that on stock indices, but ones that go down day by day, and I'll explain that in a second. One of my favorite strategies is waiting for the crash or the rally to end and catch it on the way back. and you only do that when it's going against the trend. If you can see this chart right here on the NASDAQ, you can see that it's been trending up for literally years. So obviously investors are keen on what was going on in the NASDAQ and every other stock index in the world and every other company. So if they are that keen, my idea would be that they would get in at some point. But I don't want to wait and I don't want to jump in when I don't know when investors are keen. You need to see some kind of an idea. So that's where we use technical analysis on our charts. We may look for a double bottom. We may look for a falling wedge. We may look for anything. Or we may simply just look for a continued period of uptrend and get back in. So again, trading into a recession doesn't necessarily mean you're doing anything different, but there are a lot more opportunities to be aware of. But if you're going to be doing that, you need to be very, very aware of your fundamental analysis. And one of the best ways to do that, of course, is watch the market blast every Monday. Okay, here's another example of this very, very same period. Is even more dramatic than euro dollar, the Aussie dollar. The Aussie crashed while the American dollar got very strong. You can see by the figures at the peak in October of 2008 was almost $1. They were almost at par, and then suddenly dropped down into less than around 60 cents. So that's a 40% drop in value in a matter of weeks. So you can see how badly the economies were affected, not just in the States, but around the world with that subprime market crash. Okay, and gold. As we know, gold is a go-to market when you're not sure of what to do. And you can see what happened. The little yellow box there is when Lehman Brothers went out of business, and investors decided, well, let's get back into gold. Let's get into gold. And you can see from the left side of the chart that it was basically flat for, well, many years. You can see the pricing there was between $600 and $700, and then over the next few months and years, in fact, I can see right now on this, it's about 3 or 4 years into April of 2011, that prices got up into the $1,800. And if you're trading now, you know that the price is in the $1,600, $1,700 range, and it was recently in the 2000s. So that really spurred the price of gold as we know it today. The subprime market crash spooked a lot of investors, so they got into gold, and that's where we are today with that. And also the central banks have been buying gold, again, in fear of the same kind of crash. So the central banks buying gold and investors buying gold has really helped keep that value up and kept a lot of portfolios stable. Okay, another little economic crisis that we had to endure was the European crisis of 2010. Okay, I'm mentioning this one here because it really had nothing to do with frenzies or bubbles or whatever. It had to do with sovereign debt. And a lot of the European debt came from, and it was badly called the pigs, P-I-I-G-S, and it was Portugal, Ireland, Greece, and Spain. And one of the reasons that we ran into trouble, the European Union ran into trouble, was because they admitted Greece, who were basically admitted on false accounting. They admitted later they really didn't have their books in order, but there was sovereign debt all over the world. And one of the biggest problems with sovereign debt, it doesn't always end up being in your own currency. And this is one of the problems with the euro. You have 27 countries with very diverse, and at that time 28 countries, with very diverse economies. So for example, I like to talk about, let's say for example, Portugal has a grape blight, and their beautiful crops of grapes and port are suffering. That really has no effect on the German economy because they're based in manufacturing and finance, but it does affect it because they're sharing the same currency. So let's say, for example, Greece had the drachma way back when. They had a financial crisis. They could get out of it by devaluing the drachma. What would happen was tourism would boom because of the cheap holiday, the cheap currency exchange. They could export products much cheaper because of the cheap currency, and they'd get back in the game much quicker. And that happens all over the world. Unfortunately, when you're sharing a common currency, you can't do that. And this is one of the problems the European Union has. And this really affected things in 2010. And one of the things they don't talk about, and you can look this up on Google and find out, one of the things they don't talk about was when a country has a lot of sovereign debt, it's generally in American dollars. And as we just saw, after the crash of 2008, for many months, the American dollar got so strong. If you're a foreign country or a foreign anything, and your debt is in American dollars, that puts you behind the eight ball. That puts you in a lot of trouble, because your currency is suddenly worth less compared to the debt that you carry. So this has been a big problem, and it's going to be a big problem in our current economic crisis very soon. So here we are. Okay, this is one of the distinctions that you need to be very aware of. I just showed you what happened to the American dollar when they got in trouble. The American dollar got stronger. When things happen in Europe, and it's happening now, the European euro, the euro gets weaker. It's the exact opposite effect. You may have heard rumors about the world, the markets wanting the euro to be the reserve currency of the world, not the American dollar. Well, this is proof positive that ain't going to happen very soon. And the reason is the American dollar is still the reserve currency of the planet for many, many reasons, a lot to do with sovereign debt, a lot to do with the size of the economy. But again, I'm going to repeat what I just showed you. When things go bad in the States, people bail on their stocks, they go to cash, the American dollar gets stronger. When things go bad in Europe, yes, the European companies get weaker, but also the currency gets weaker. That's just the way it is. So you need to be aware of the effect on the euro when things go sour. And right now, things are going very sour for the European Union. And hopefully, fingers crossed, we can get out of it. And I'll be going. Unless you just arrived on the planet a few days ago, you'll know exactly what I'm talking about. So, moving to the next crisis. Next crisis, we all know very well, COVID-19. And this was something that we'd never really seen before. We had seen it, of course, the Spanish flu of 1918 around there. But that was obviously a huge economic problem, a huge health problem. And here we have the same thing happening now. Fortunately, we're just coming out of it. But this caught the central banks and governments and markets really off guard. And a lot of things happened that we really didn't expect. A lot of things happened that we did expect. For example, the price of oil. So when you've got economies locked down because of a pandemic, obviously production stops, the air gets cleaner because those factories are shut. But the biggest thing that happened to the markets was the price of oil collapsed, basically. In fact, you can see this is a cash price that you may be trading on the Valutrades MT4. It went down to about $9 at one point. So if you're trading a few years ago, $100 a barrel, and you can see that this chart shows about $70 a barrel coming into the pandemic, it went down to $9 a barrel, which is unheard of. The 2-month contract on WTI went to minus $42, and that really wasn't to do with supply and demand. It was to do with storage. At the time, there was no place to put it. So this was one of the easiest trades we've ever made. Basically, you know that the market cannot survive at $9 a barrel oil. You know that the pandemic's going to come to an end at some point. We hoped. If it didn't, it wouldn't really matter anyway. Pardon that black humor. But it was one of the easiest trades that anybody ever made in their life, buying in at $10, $20 a barrel, and you can see from the chart that prices climbed up. So this is taking advantage of a very bad situation. And as I said earlier, not many people took the trade on the way down. In fact, it was probably very difficult to take the trade on the way down because not a lot of brokers would have let you in on that trade. But on the way up, the spreads were a lot narrower, a lot easier to get in, a lot more liquidity. And you know for a fact, and if you watch interviews with the big chairmen of the oil companies, they like to have their prices at least $35 a barrel. Aramco likes it to be about $60 a barrel, so you know that no one's going to be living with $20 and $30 barrel in oil, so a barrel per dollar per barrel. So that was an easy trade that we got into. Now we are in a very different situation with oil. We'll come back to that in a minute. Okay, and the same with the pandemic. The Dow Jones Industrial Average tanked basically, and you can see what happened there. It went from 30,000 down to 18,000 in literally a matter of weeks, and it was a steady crash. There were a lot of us who were very, very worried. I mean, this is very serious. And I'm going to show you a quick chart that you may not be expecting. And this is the Australian index. Give me 2 seconds, please. And again, another personal story. During the collapse from the pandemic, I was waking up at 4 o'clock in the morning with my iPad next to my bed just to see what would happen at the Australian Open. Because it was a genuine worry. I mean, you're thinking, what happens if the stock markets totally collapse? We're back in the 1929. This is not good. And after 3 days, the stocks just kept falling. So I was watching the Australian Open every morning, and suddenly I started to realize on the fourth day, there was some buying, and the fifth day there was some buying. So it wasn't all doom and gloom. And I remember saying to my wife, "Yeah, we're going to be okay." As you can see by the charts, the stock markets did keep falling, but you can also see some green candles there. And this is really important to understand. This is a very, very good lesson for this recession, that crisis, is the resilience of the investor on this planet. It doesn't matter whether they're American or Australian or British. In fact, you may remember from an old episode of Dallas way back when, J.R. Ewing made a very profound statement. He said, when times get tough, you don't sell, you buy. Sorry, I can't do that with a Texan accent, but I'll repeat it. When times get tough, you don't sell, you buy. And that's what good investors do. They, as we say, if you watch my videos, you'll hear me say, buy the dip very often. And on Bloomberg, they talk about dip buyers all the time. And that's been a very good strategy for many years. Up till recently, it had worked quite well. It will be back because there's a lot of cash out there. The people who have the cash don't want to be sitting in cash because the interest rates are still very low. They want to be where the action is. So they will still be buying stocks, which is a very, very good thing. When times are tough, they'll be buying bonds, they'll be buying gold, and they may stay in cash. There are some places that will give you 12% on your money in banks in Malaysia, places like that. But for the most part, people like to be with the big stocks, the blue chip stocks. So what's important to learn from these crashes over the recent crashes was the resilience of the investor, the American investor, the British investor. It doesn't matter where you are in the world. We've had some bad experiences, but we've always come back. So between the investors and the central bank, they've basically saved us from 1929. You may not want to thank them right now, but it's something to keep in mind. Right. Leading into our most recent crisis, I was on a panel right when when Russia invaded Ukraine, and there were a panel of different experts from various parts of the financial world, and we all had a series of questions to answer. And the question that was asked, one of the questions that was asked was, is this about the worst time for Vladimir Putin to declare war, to invade another country? And of course, everyone had a different answer, a lot of humanitarian answers, a lot of political answers. My answer was purely financial. And I said, look, the central banks right now are just coming out of a pandemic. They are struggling to get inflation under control. And it looked like they were going to do it. And we were joking about the word transitory because Jerome Powell and Andrew Bailey were saying, oh, inflation is transitory. And the rest of us are saying, well, what does that mean? We were hoping it's transitory. It turns out it wasn't. So what Vladimir Putin did was completely, besides creating a horrible situation in Ukraine, killing lots and lots of poor innocent people, and causing a massive economic problems for Ukraine, he's actually created massive problems around the world, because when the central banks are trying to fight inflation and it looked like they had the mechanism to get it under control, then this came along. And again, to answer the question of the panel, this was the last thing the world needed for many, many reasons. So here we are now in our current crisis. And I tell people, well, if you want to blame the government for what's going on, blame the Russian government, because a lot of what's happening is, in fact, most of what's happening is not just to do with the pandemic, which we may have been out of by now. We did not need Russia to invade a totally innocent democratic country next door to them. We'll go into what that means in a minute. So one of the things that was really badly affected by the Russian invasion of Ukraine, and for traders, this is really important to keep in mind, is the price of natural gas. And natural gas is now available on the Valutrades MT4 platform. It's a fundamental story as well as a technical story. If you caught my market blast recently, I'm looking at the technical aspect of natural gas. You can see on this chart, it's sitting right there at support, but you basically shouldn't be trading it until you know that we've broken through support or there's some good news coming out of Russia. And one of the things that, as I mentioned earlier, trading, normally you're trading in a recession, can be the same thing, but you can see the volatility on natural gas. And the reason natural gas shot up was because basically it was a supply and demand story coming out of Russia. I mean, I live in southern Spain. I buy gas bottles, and for years and years and years they were 13 euros. Now they're 18, 19, 20. And the price fluctuates up and down at the petrol station for these natural gas bottles. But what's happening, of course, is that you've got a serious problem with supply in that Russia is basically sending, or was sending, is sending, trying to send, not sending, their gas into places like Germany. And the German economy could really, really badly suffer because of the supply of natural gas, not so much to keep themselves, obviously to keep themselves warm in the winter, but many, many things rely on natural gas, like creating fertilizer. If you can't create fertilizer, you need a lot of natural gas. If you can't create fertilizer, it's going to affect the farming. If you have farming being affected, it's going to affect food and food prices. So the whole thing, the whole global economy is really at the mercy of the supply of natural gas. So it's a big problem. So you can see why prices have gone up on this chart from just over $3 for a million BTUs up to almost 10, or in fact past 10. And basically, again, getting back to trading it, you really need to be aware of the fundamental analysis and what's going on with that. You can see on this chart right now, there's a big, beautiful head and shoulders pattern sitting on resistance, so support, sorry. So that's a trade that's waiting to be waiting to be taken. Again, but you need to be paying attention to what's going on. I'll give you an example. European countries, especially Germany, had started to stockpile natural gas. When it came to the point where they said, hey, we've got enough to last the winter, the price of natural gas came down. Of course, when Vladimir Putin threatened to turn off the flow of natural gas, the price goes back up. So it's a bit of a tug of war with natural gas, but it is very, very important symbol to trade, again, on the fundamental side and the technical side, recession or no recession. Okay, same with WTI. The flow of oil coming out of Russia was basically the threats were there that was to be interrupted. Fortunately, oil, WTI or Brent crude, is much easier to send around than natural gas. So that's why prices have come down a bit and stabilized. You can see now it was up to over $128 a barrel for West Texas Intermediate crude, and it's now in the 80s. And again, it's a fundamental story based around Russia. After the pandemic, during the pandemic, as we saw, the price of WTI and Brent crude fell dramatically, but as demand and the economies came back together, the price of oil went up. So this is something that you can not easily trade. You need to be aware of what's going on with it and watch the fundamentals. But oil is another product, another symbol that you can trade, whether it's on futures or on cash, whether it's WTI or on Brent. Okay, I'm going to jump ahead now just to refresh your memory. This is my order of analysis. So whether I'm trading natural gas or currency or oil, I always follow this order. I make sure I understand the fundamentals of what I'm trading. Okay, you need to know what's going on. If you know there's an interest rate rise, an interest rate decision coming this week, and you want to trade a currency pair, you're better off waiting to see what's going on, because that's a fundamental story. Or if you already know, you have a magic crystal ball, then jump in. Then look at support and resistance. That is key, critical support and resistance. Then I look at my chart patterns, especially things like head and shoulders, as I just mentioned, double tops, double bottoms, rising and falling wedges, which are critical. They're almost always right. Then I look at my indicators like the stochastic oscillator, moving averages, and then candle patterns. So I always follow that order. I know people who like to trade based on the stochastic oscillator or RSI or even candle patterns. I have them 4th and 5th on my list because I like to look at the first 3 first. Fundamental, I want to know what's going on in the world. Support and resistance, where was the last point where the market was willing to buy or sell? Chart patterns. Chart patterns for me represent the mood of the market. They graphically represent what the market is thinking and where they're hopefully where they're going to go with it, which gets back to fundamentals. So I just thought I'd throw that in there because it's important to understand. I've got students who have taken this very slide and stuck it on their wall. It's important to follow this rule, for me anyway, as part of my trading strategy. Okay, we've looked at our current situation, and our current situation is just that. We're in a pickle right now based on coming out of COVID and the turmoil caused by the Russia-Ukraine conflict. So you're going to ask the question, what is a recession? Well, a recession basically, technically, is 2 consecutive quarters of negative GDP. That's the rule. Well, I can tell you hand on heart that rule has been basically thrown in the bin right now because there's so much else going on. There's so much else that have caught the central banks off guard. Again, supply and demand has been turned upside down. I mentioned earlier, storage of oil was a problem for a while. That's no longer a problem. The biggest problem right now is not necessarily GDP, it's inflation. So basically, you know, you can look at these particular calendar snippings I've taken off of the economic calendar. It shows preliminary GDP in the US, advanced GDP in the US, and it follows a couple of quarters. For example, back in February, the preliminary GDP quarter by quarter was 7%. So it was much higher. Suddenly it dropped. It went to minus 1.5, and then if I can see that, it went to minus 0.6. So technically, those 2 consecutive quarters of negative growth. So does that mean the United States is in a recession? Well, if you ask Jerome Powell, he'll say no. If you ask Janet Yellen, he'll say no. If you ask a lot of hedge funds, they may say no. Some of them will say, no, we've been in a recession for 2 years now. So it's becoming subjective as to what is a recession, and it almost doesn't matter. And I'm going to show you why in a second. And this is why. The biggest problem right now around the world for every central bank and every government is inflation. I'll touch on very quickly right now, it's a huge problem for the Democratic government in the United States because inflation is making them look bad coming up to the midterms. However, the price of petrol, the price of gas in the States is coming down, which makes everybody look good. Again, these things are not driven by politics, they're driven by socioeconomics and geopolitical events like pandemics and invasions of countries. But unfortunately, people like to blame the government. So right now, the government and the central banks have a big task at hand, and that's getting inflation under control. And again, I'll repeat, coming out of the pandemic, inflation was caused by a number of different things. And one of the things I forgot to mention was the labor shortage, which caught everybody by surprise. Everybody thought, okay, we're coming out of the pandemic, we're feeling better now, let's go back to work. Well, a lot of people didn't. So inflation was actually, a lot of inflation was caused by labor shortages and having to hire people at a higher wage to get products out the door. Productivity was bad, which caused inflation because of social distancing. The rise in the price of natural gas, as I mentioned, caused huge inflation problems all over the world. The impeding the agricultural business in the Ukraine, a huge producer of wheat, caused inflation because of productivity and not being able to get wheat out, which is fortunately happening now. And of course, because of the problems we're having with oil in terms of the price of oil. So all these things cause rampant inflation. And you can see by this chart, this is the chart of the G20 countries. And if I look at the chart, I'll touch on it very quickly because some of them are almost humorous. I mean, Turkey right now is running at 80% inflation as of last month. And that's not really based on any supply and demand issues. It's actually based on religious issues. The central bank and the government don't want to raise interest rates because it goes against their religion. I don't want to get into that. If you don't believe me, look it up. Argentina is running at 78% inflation. That's basically for economic reasons. They've been a badly managed country economically for many decades. And that's not likely to change. Russia is third on the list, 14% interest rate, but the economy is suffering because of sanctions being put on them. Spain as well. I mean, Spain has a big problem with inflation because of electricity costs. They made a big mistake decades ago when they bought futures in electricity, and it's actually the most expensive electricity in Europe outside of Greece and Cyprus, which are islands. Go figure that out. I live in Spain, and we're getting subsidies now on gas and electricity, so it's not so bad. But the biggest problem we've got right now is the inflation in the United Kingdom, or the biggest problem they have. And there are poor families literally deciding whether to pay the rent or buy electricity or buy food. It is that bad in the United Kingdom. And that is why one of the reasons that the pound is shrinking. And I'll show you the chart in a minute. And again, trading into a recession, that is an opportunity. Obviously, we feel for the poor people of the United Kingdom who are trying to feed their families. But when we see a currency dropping like this, at some point, it will probably reverse. And we will take advantage of that. And that's one of the things that we need to be looking at very seriously. So again, if you look at the top of the chart, you've got Japan at 3%. That's been an interesting case. Inflation has been running rampant around the world for many, many years. Japan had a problem with deflation during the pandemic, which is one of the reasons they're in such a mess they are right now with the central bank. And I'll touch on that in a second. Right. So let's look at the individual economies. One of the promises we made in the beginning of this webinar was to look at the individual economies and how we can trade them. The United States, the American dollar, is just getting stronger and stronger and stronger, and that's not a good thing. Again, I mentioned one of the reasons why is that a lot of emerging markets and countries have their debt in American dollars. That, to be honest, is going to be causing in the next few months or maybe the next few years another crisis. But this is why we have the IMF, the International Monetary Fund. But watch this space. Basically, if the American dollar doesn't start to come down in a little bit, it's not going to be good for the global economies all over the world. It causes exports, as I said, and debt. So basically, as traders, we're going to be watching the American dollar. And you can see by these charts that the American dollar is quite strong against everything except the Swiss franc. And when the Swiss franc gets strong, you know investors are moving into safe havens, because typically the safe havens had been gold, Swiss franc, and the Japanese yen. Well, the safe havens now are the Swiss franc and gold, and mostly the Swiss franc. So you can see how the American dollar is quite strong against everything except the Swiss franc, and that goes to show you it's not a good sign either, to be honest. Okay, and basically getting back to, sorry, I should have finished on the American dollar. This week coming up, and you need to be watching Jerome Powell and the Fed raising interest rates, because when interest rates go up, the currency goes up. It's that simple. So one of the things that we like to do is do the counter trend trade with interest rates and CPI and things like that, and I'll show you that in a second. Okay, Europe, as I mentioned, when things go bad in Europe, the currency gets weaker, but we can see right now that the currency is actually getting stronger against almost everything except the American dollar. You can see it quite strong against the pound and so forth. So the euro is getting stronger because finally they're looking at raising interest rates. And again, this is an important thing to understand. The euro will be getting stronger when we get good fundamental news about the price of natural gas, about the price of oil, and just generally investment in the economy. I would say if the war in the Ukraine stopped right now, the euro would fly. It's that simple. Okay, as we mentioned, the United Kingdom, big problems with inflation. They'll be having an interest rate rise, hopefully this week after the Fed and carrying on into next year. Oh, that's one more thing as well. The interest rate rises they're predicting for the next several months should be coming back into 2023. So there's another opportunity for us. When a country when it lowers its interest rate, it devalues the currency. So that gives us another opportunity to trade a certain currency. So the pound right now is one of the weakest currencies on the planet, and at some point that should stop, because the UK economy is not to be trifled with. It's an important economy, and if history shows us anything, it will settle down. Now they have a new prime minister getting back to work this week after the after the royal funeral, and so forth. So and now they'll be free to negotiate trade deals and so forth with other countries, coming out of Brexit, coming out of the pandemic, suffering because of the price of petrol, basically. The United Kingdom, in theory, should be coming back online, in which case the pound will be getting stronger with Andrew Bailey's interest rate rises, and then that's another way we can trade it, a stronger pound, we hope. Okay, Japan. This is one of the most important currencies to watch during this particular recession. As I mentioned earlier, the Bank of Japan simply did not want to raise interest rates. And one more thing, when the central banks have two tools to help with inflation. Raising interest rates actually calms the economy down, which actually creates demand destruction, which brings prices down. It's that simple. They can also increase the value of a currency by slowing down their bond purchasing. Okay, the Japanese Bank of Japan didn't have that luxury because of the differential between bond prices in Japan and the United States. It simply wasn't going to work for them. So, and also they were fighting deflation during the pandemic, not inflation. So raising interest rates would have done them no good at all at the time. Now they've got a bit of inflation, 3% versus, say, higher rates like 11% or 10% around the world. Doesn't seem like much, but they are now coming into an inflationary period, but they're still not ready to raise interest rates. We'll see about that. But that is a very important trade that we've been watching, is the reversal of the yen. The yen has been very, very weak for a long time. And for everybody's sake, it needs to get stronger, especially for the sake of the Japanese. You'd think that a weaker Japanese yen would help exports, and it certainly has, but it has not helped investment, so which is a big problem in Japan. So again, trading into this recession, keep an eye on the Japanese yen, keep an eye on our Market Blast videos. We'll be definitely looking at the big reversal on the Japanese yen. Okay, Canadian dollar lately has been looking quite weak, and that's very simple. The price of oil. As the price of oil falls, as you saw on the chart a little while ago, the Canadian dollar will fall. One of the interesting things about the subprime crisis back in 2008, Canada really didn't suffer because of that, because all their mortgages they didn't have that crazy frenzy, that housing bubble, and all the mortgages were protected by the government. They did suffer, however, because being a neighbor of the United States and a big trading partner, it did happen. But right now, the Canadian dollar, again, like anybody, are trying to get inflation under control. That chart we saw on inflation, the Canadian economy wasn't as bad as some, but still wasn't as good as it could be. So the Canadian dollar is being driven right now by the price of oil. And you can see on many cases against the American dollar, especially, it's not doing that well. So watch the price of oil, watch the interest rate rises from the Bank of Canada, and watch to see how they're fighting inflation. Okay, I mentioned Switzerland. The Swiss franc is getting stronger and stronger against everything except the dollar. If you look at the top left chart there, that it's dollar Swiss. It's not really level, but it is sort of level if you look right across the entire chart, because you've got one thing we don't want to do as traders is trade one strong currency against another strong currency. So when I see the Swiss franc getting stronger and stronger, it is not really a good sign. It tells me that a lot of investors are going into safe haven like the Swiss franc. But it's something to keep an eye on. We'll be looking for the reversal. Watch your support and resistance. Watch your indicators, and watch our videos. And we'll hopefully let you know when we think that the Swiss franc will be heading back south again. Okay, the Australian dollar is also one to keep an eye on. It's an important currency. It is very affected by China because of the exports into China. And also the price of gold. As you know, lately gold has been falling, so the Australian dollar has been falling. It's that simple. So the Chinese economy, they need to be producing more. They need to be a much more better functioning economy to help the Australians. Australia right now is also trying to tackle inflation. I apologize. One chart I didn't create was the New Zealand chart, which is actually one of the weakest currencies right now. Yes, New Zealand is definitely tied to the Chinese economy. One of the reasons that the Kiwi economy is the Kiwi dollar, the New Zealand dollar is falling so much is, ironically, the price of dairy products is actually falling, contrary to everything else in the world, which is being hit by inflation. So that's something to watch. I remember years and years ago, I used to trade the New Zealand dairy product report. It was actually easy to trade because it was almost always wrong, and it almost always gave us some really good momentum. So perhaps we'll look at that in future Market Blast videos. So again, New Zealand has raised their interest rates. They've done all the right things. The economy is under control, and they haven't reported inflation since June, which is weird. But keep an eye on that. So keep an eye on the Market Blast videos. We'll talk about New Zealand inflation and the perhaps the dairy products as well. If you're going to trade anything, especially into a recession like we are now, you need to be very, very aware of the economic calendar. And here we see a slew of central banks, the Fed, the Bank of Japan, the Swiss National Bank, and the Bank of England, all looking at interest rates. These are the guys that will drive their currencies and drive their economies. If a central bank raises interest rates too much too quickly, they could drive their economy into a recession, which is the last thing we want. If they don't raise interest rates, then inflation will carry on, and perhaps worse problems. One of the good things right now, especially in the United States, is their unemployment rate is actually quite low, which is ironic considering the state of the economy. So the idea for these guys is to get inflation under control. So basically watch this space, and this is where we are trading. We're watching our trades right now is going in with the central banks. And the way we trade that, we don't just say, oh, well, the Fed's going to raise interest rates, therefore we're going to go long on the US dollar. That is not how I trade. That is not how I make my bread and butter as a professional trader. I look at what I used to call it the counter trend trade, but that's really not quite. So I'm calling it now the counter trend price action trade. So basically, the way this works, as traders, we need to know trends. We need to know which way the market is going, what is the trend basically. And we don't want to go against the trend. What we want to do is let these news events, let these central bank interventions drive price against the trend, and then we as traders jump in on the way back. It doesn't always work, but if you're careful, it can work 80% of the time, and you can be a very profitable trader. So here we have, for example, a dollar Swiss chart, dollar Swiss daily chart. Yes, it's a dollar Swiss daily chart, and you can see the trend lines. Basically, when price action is driven by news events into, let's say, the upper trend line, you follow your stochastic oscillator, whatever other indicator you like, you follow your parabolic SAR, your moving averages, you wait for that price to bounce back, and then you take the trade short with the trend. That is called counter trend price action trading. And basically, it's the same as any trading, but trading into a recession will give you a lot more opportunities like these because there's a lot more going on. There's a lot more going on with the central banks, with our friend Vladimir Putin when he decides he wants to turn off the flow of oil or gas. There's just so much going on right now to trade. And again, I can't repeat enough. Trading in a recession is just like trading normally. It's just that there are a lot more opportunities, and be careful, a lot more volatility, a lot more ways to go wrong. But again, I'm going to go back to my order of analysis. Understand the fundamentals and understand what the central banks are going to do. Look at your economic calendar, then look at support and resistance, whether it's a trend line or a horizontal line. Then watch your chart patterns indicators, your oscillators, then your candles if you wish, and then jump in the trade. But be very careful. If you have any questions on counter trend price action trading, please feel free to send me a note. I'm happy to explain it. I've actually done some videos on this, and I'm glad to send them off to you. Anyway, I hope that was valuable. So here we are talking about the state of the economy, the state of our global various economies and recessions, if we are in a recession. And again, we can debate whether we're in recessions or not. The biggest problem we have right now is inflation. So what I want you guys to do is to understand your fundamentals and take advantage of this, and keep watching our videos. And thanks a lot for watching, and we'll see you soon.